Why still talk about this trade since markets are 9 months discount into the future? Why isn't this already baked in? It just across the board.
Yeah. You know, it's a good question to ask, Joe. Quite frankly, we talked about this a year ago. I remember giving you picks for reopening, and everyone was kind of like these wide eyes, right? Kind of thinking, how can you possibly be investing in this theme? So fast forward, here we are. The reason is because I think the stimulus is working, and it's not going away, even if the Fed decides to taper, right? So the economy continues to grow. We have a little bit of inflation. I could give you 20 different companies that told me that they are raising wages. So inflation is real. It's not all transitory. Some is transitory, but not all. So if you believe in better growth, you believe in a little bit more inflation, the Fed is going to taper, rates are going to go a little bit higher, you want to own more value, you want to own more reopen names, because these areas are still very depressed, quite frankly. And I think you are going to see a shift from the goods names doing well to the services names doing well. There's a ton of pent-up demand. You and I have talked about this. Savings rate of 27%. If it goes to 5%, which is the kind of the mean, that's almost $2 trillion in pent-up demand for spending. So I think you definitely want to invest in reopen names. Okay,
but you did distinguish between the entire group and certain parts of the group. So do you think some of these have already moved to the point where they're no longer cheap and some have not because they're overlooked, or is it they do different things? What makes something more viable here than something else if they're both involved in reopening?
Okay, yeah. No, I mean, and that's also a good question. You want to find companies that are still kind of down and out. Look, I mean, I'm picking Boeing as one of my reopen names. It's still down 40% from its highs, right, a couple of years ago. And I think the air traffic returning to normal, we're still a ways to go there, right? And then you want to pick something within not only just reopen, but you had Airbus make their announcements about production increases. What does that mean? That means you're going to have an additional 450 planes on top of all the other deliveries that they're making between now and 2024. And that's real momentum. Plus, you've got a replacement cycle. 21% of their wide bodies are over 20 years old. So think of the energy efficiencies that these companies can get if they actually upgrade. And so you have production going up, you've got deliveries going up, that means free cash flow goes up. And, oh, by the way, you have a catalyst with China in the second half of the year if they recertify the 737 MAX. So it's not just reopen. It's kind of a restructuring and a reopen. Same thing with GE. Larry Culp has done a great job in the last 2 years, kind of right-sizing the company, shrinking to grow, focusing on healthcare, focusing on aviation. But they, too, will benefit, especially Airbus, because they're one of two that produces the engines to Airbus, right? So all of a sudden, Airbus raises production, and then GE sees kind of a windfall on their engines businesses. And that's something that they do very, very well. So, again, it's a restructuring plus a reopening, and you want to have a combination of that kind of thing. And we can go on to Marriott and Wynn. Those are more obvious kind of reopen names. But I do think that with regards to Marriott, I don't think we've seen earnings inflect yet at all. Because you really haven't seen occupancies really improve. They're improving sequentially, but they're still down quite a bit. And Wynn, it's all about Macau. And Macau gaming in the month of May was up 492% year over year. I know easy comparisons, but it is what it is. The numbers are there. The traffic is returning. So I like a little hodgepodge of the reopen names.
Steph, you mentioned the one reason is the stimulus is working, so that's a positive. I want to ask you to put your macro hat on just for a second. Included in President Biden's budget are a lot of estimates for where we're headed in terms of growth, and they acknowledge that that we've spent a lot fiscally and monetary. We spent a lot. So for 2021, we get 5.2% growth. 2022, 4.3% is the estimate. Who knows whether it's true? But then, because of all the spending, the next 8 years average 1.9%. And the administration is almost acknowledging that demographics and productivity will make it hard to get anywhere above that. Is that okay? Will that be okay for the markets? Will that be okay for financial assets that we go, it sounds like malaise to me, and that we can do so much better. And it sounds like we're going back to splitting the pie up better, but not growing the pie as much as we could.
Yeah, I mean, look, I mean, the stimulus is working for this year. The stimulus will work for the following year. Then we have to see what the Fed does, right, and how aggressive they will be in terms of raising rates. And that is absolutely, and in addition to tax increases, and that is absolutely going to slow growth. As an investor, and I am a long-term investor, but I think for the next year or two, this theme of owning cyclicals and owning economically sensitive companies because the economy is doing well, owning companies that have operating leverage, that are reopening, all of those themes are packaged into my portfolio for this year and for maybe the beginning of next year. At some point, we're going to have to figure out, maybe we have to shift. I don't think it's bad for the markets if you have 1.5%, 2% growth. We don't want that. But that just means the way you run a portfolio has to change. And this year, it's been all about rotation, right? So it might be all about rotation next year, just into different parts of the economy. By the way, if you do see slower growth and you see inflation kind of dampen in the next 2 years or so, you are going to want to own more growth versus value. But for the time being, you want to own value over growth and small over large, mainly because the economy has juice and there's more operating leverage in those names.
The other part I didn't mention, I was reading from the journal's lead editorial, Wall Street Journal, but they use the word secular stagnation. So they're not saying that the lower growth causes inflation to moderate. They're saying it comes in combination with that. So that definitely is not the greatest environment. We'll see. It's not the greatest environment for financial assets, but we got time. We got 2 years of above trend growth, which you're going to try to take advantage of, Stephanie.
Shepard Smith here. Thanks for watching CNBC on YouTube.